What is economy? Picture this. You wake up, grab coffee from your local shop, drive to work using gas you bought yesterday, and get paid at the end of the week. Every single one of these actions is part of something massive called the economy. The economy isn't some abstract concept floating in space. It's literally every transaction, every job, every purchase happening around you right now. When your neighbor buys groceries, when Amazon delivers a package, when your friend gets a raise, that's all the economy in action. Think of the economy like a giant circulatory system. Money flows like blood through arteries and veins. Businesses are the organs, workers are the cells, and government is like the brain trying to keep everything functioning. When one part gets sick, the whole system feels it. The economy has three main players: households like yours that spend money and provide labor, businesses that produce goods and services, and government that sets rules and spends taxpayer money. These three groups are constantly trading with each other, creating this endless cycle of money changing hands. But here's what most people don't realize. The economy isn't just about money, it's about resources, time, materials, human skills, technology. Everything has limits, and the economy is basically humanity's way of deciding who gets what and how much they pay for it. Supply versus demand. Imagine you're at a concert. There are only 1,000 tickets available, but 5,000 people want to go. What happens to the price? It skyrockets. That's supply and demand in its purest form. Supply is how much of something exists. Demand is how badly people want it. When supply is low and demand is high, prices go uppy. When supply is high and demand is low, prices go down. It's like a seesaw that never stops moving. Let's say a new iPhone drops. Apple only makes a limited number on launch day. That's low supply. But millions of people want it immediately. That's high demand. Result? People pay premium prices, sometimes even more than retail from scalpers. Now flip it. Remember when everyone was buying bread makers during lockdown? Suddenly, bread makers were everywhere. High supply. But after a few months, people got bored. Low demand. Prices crashed, and you could find bread makers for half price. This isn't just about products. It works for everything. Job markets, housing, even dating apps. When there are fewer available jobs, employers can pay less because workers are competing. When there are fewer available workers, wages go up because employers are competing. Supply and demand explains why concert tickets cost more than movie tickets, why beachfront property costs more than inland property, and why brain surgeons make more money than cashiers. It's the invisible hand that sets almost every price in your life. Inflation versus deflation. You walk into McDonald's and order the same meal you've been getting for years. But wait, it costs $3 more than last time. Welcome to inflation, the silent thief that steals your purchasing power while you sleep. Inflation means prices are rising across the economy. Your dollar buys less today than it did yesterday. It's like your money is slowly shrinking in your wallet. A little inflation is normal, even healthy. About 2% per year keeps the economy growing steadily. But when inflation gets out of control, chaos follows. Imagine paying $20 for a gallon of milk or $100 for a tank of gas. That's hyperinflation, and it destroys economies. Germany experienced this in the 1920s when people literally needed wheelbarrows full of cash to buy bread. What causes inflation? Sometimes it's too much money chasing too few goods. The government prints money, people have more cash, but there aren't more products to buy, so prices rise. Sometimes it's supply chain problems. If oil gets expensive, everything that uses oil gets expensive too. Now, deflation is inflation's evil twin. Prices are falling across the economy. Sounds good, right? Wrong. Deflation is actually worse than inflation because it creates a death spiral. If you know prices will be lower tomorrow, why buy anything today? Everyone stops spending, businesses fail, unemployment rises, and the economy collapses. Japan experienced deflation for decades, starting in the 1990s. People stopped buying houses because they knew they'd be cheaper next year. This created a feedback loop where the economy stayed stuck in neutral for 20 years. The sweet spot is mild inflation. Prices rise slowly and predictably. People keep spending because waiting doesn't save them much money. Businesses can plan for the future. Workers get regular raises. GDP and why it's flawed. GDP stands for Gross Domestic Product, and it's supposed to measure how well a country's economy is doing. Think of it as the economy's report card. It adds up the value of everything produced in a country during 1 year. If you buy a car, that counts toward GDP. If a company builds a factory, that counts too. Government spending on roads, military, schools, all of it gets added up. The bigger the number, the better the economy is supposedly doing. Politicians love talking about GDP growth. Our economy grew 3% this year, they'll say, like it's proof they're doing a great job. And for decades, everyone believed believed GDP was the ultimate measure of success. But here's the problem. GDP measures activity, not quality of life. If there's a massive hurricane that destroys a city, GDP actually goes uppy because of all the rebuilding. Crime can boost GDP because people buy security systems. Pollution can boost GDP because companies spend money cleaning it up. GDP doesn't count unpaid work. If you hire someone to clean your house, that's GDP. If you clean it yourself, that's zero GDP. A stay-at-home parent raising kids contributes nothing to GDP, but a daycare center does. How does that make sense? GDP also ignores inequality. A country where one person makes $1 billion and everyone else makes nothing could have high GDP per capita, but most people would be miserable. GDP doesn't care about the distribution of wealth, only the total amount. Recession versus depression. A recession is when the economy catches a cold. A depression is when it gets pneumonia. Both involve economic decline, but the severity and duration are completely different. Technically, a recession is 2 consecutive quarters of negative GDP growth. That means the economy is shrinking for at least 6 months. Unemployment rises, businesses close, stock markets fall, and everyone tightens their belts. Recessions happen regularly, about every 7 to 10 years on average. They're like forest fires, destructive but also natural. They clear out weak businesses, reset prices, and make room for new growth. Most recessions last 6 to 18 months before recovery begins. The 2008 financial crisis was a recession. Unemployment hit 10%, millions lost their homes, and the stock market crashed. But within a few years, things started improving. New businesses emerged, housing recovered, and unemployment fell back to normal levels. A depression is a recession's nightmare older brother. It's deeper, longer, and more devastating. The Great Depression lasted from 1929 to 1939, 10 years of economic misery. Unemployment reached 25%, banks failed by the thousands, and entire industries disappeared. What turns a recession into a depression? Usually it's a combination of factors: banking system collapse, government policy mistakes, international trade breakdown, and loss of confidence that feeds on itself. The key difference is hope. During a recession, people expect recovery within a year or two. During a depression, despair sets in. People hoard cash, businesses stop expanding, and the economy stays stuck in a downward spiral for years. Productivity. Productivity is the secret source of economic growth. It's not about working harder, it's about working smarter. Productivity measures how much output you get per unit of input, usually per hour of work. Imagine 2 farmers. Farmer A uses a shovel and plants 100 seeds per day. Farmer B uses a tractor and plants 1,000 seeds per day. Farmer B is 10 times more productive, not because he works 10 times harder, but because he has better tools. This is why some countries are rich and others are poor. It's not about natural resources or population size. Japan has few natural resources but high productivity. Nigeria has oil but low productivity. The difference is technology, education, and efficient systems. Productivity growth is what allows living standards to improve over time. When workers become more productive, they can demand higher wages. When companies become more productive, they can offer lower prices or higher profits. Everyone wins. The Industrial Revolution was a massive productivity boom. Steam engines, assembly lines, and mechanization allowed one worker to produce what previously took 10 workers. This created unprecedented wealth and transformed human civilization. Opportunity cost. Every choice you make costs you something else you could have chosen instead. That's opportunity cost, and it's one of the most important concepts in economics. It's not just about money, it's about time, energy, and possibilities. A billionaire's time is worth thousands of dollars per hour, so they'll pay someone else to do tasks that would save them money but cost them time. A minimum wage worker might spend hours clipping coupons because their time is worth less than the money they save. College is a perfect example of opportunity cost. You're not just paying tuition, room, and board. You're also giving up 4 years of potential earnings. If you could make $30,000 per year without college, your true cost of college includes that $120,000 in lost wages. But the opportunity cost of not going to college might be even higher. College graduates typically earn much more over their lifetime. So even though college is expensive, the opportunity cost of skipping it could be hundreds of thousands of dollars in lost future income. The key insight is that resources are limited. You can't have everything, so you need to choose wisely. Understanding opportunity cost helps you make better decisions by forcing you to consider what you're giving up, not just what you're getting. But scarcity Scarcity is the fundamental problem that economics tries to solve. We have unlimited wants but limited resources. Everyone wants more money, more time, more stuff, but there's only so much to go around. Some resources are naturally scarce. There's only so much oil in the ground, so much gold in the earth, so much beachfront property on the coast. As these resources get used up, they become more valuable because supply is limited. But scarcity can also be artificial. Diamonds aren't actually that rare, but the diamond industry controls supply to keep prices high. Concert venues could build bigger stadiums, but they keep them small to create scarcity and charge premium prices. Scarcity drives innovation. When something becomes scarce and expensive, entrepreneurs look for alternatives. High oil prices led to electric cars. Expensive labor led to automation. Scarce land led to skyscrapers. Understanding scarcity helps explain why everything costs money, why you can't have everything you want, and why trade-offs are inevitable. It's not a bug in the system. It's a feature of reality. Capital versus labor. In every economy, there are two main ingredients for creating wealth: capital and labor. Think of them as the tools and the people who use those tools. Labor is human effort, physical work, mental work, creativity, problem solving. When you flip burgers, write code, or perform surgery, you're providing labor. Your time, energy, and skills are the labor input. Capital is everything else used to produce goods and services. Machines, buildings, computers, trucks, software, even money itself. The burger restaurant's grill is capital. The programmer's computer is capital. Here's the key insight. Capital makes labor more productive. A construction worker with a bulldozer can move more dirt than one with a shovel. A writer with a computer can produce more content than one with a typewriter. Capital amplifies human capability. Throughout history, the balance between capital and labor has shifted dramatically. In agricultural societies, land was the most important capital. In industrial societies, factories and machines became crucial. In today's knowledge economy, information and technology are the key forms of capital. Quantitative easing. Quantitative easing sounds complicated, but it's actually simple. It's when central banks create new money out of thin air and use it to buy government bonds and other securities. Think of it as the ultimate money printer going, here's how it works. The Federal Reserve creates digital money by typing numbers into a computer. No physical printing required. They use this new money to buy treasury bonds from banks and other financial institutions. This puts cash directly into the financial system. Why would they do this? Usually during economic crises when normal monetary policy isn't working, central banks typically fight recessions by lowering interest rates, making it cheaper to borrow money. But what happens when interest rates are already near zero? You can't go much lower. That's when quantitative easing comes in. By buying bonds, the Fed increases demand for them, which drives up their prices and lowers their yields. The goal is to stimulate economic activity. Lower borrowing costs should encourage businesses to invest and expand. Higher asset prices make people feel wealthier, encouraging them to spend more. More spending means more jobs, which means more income. Quantitative easing was used extensively after the 2008 financial crisis. The Fed's balance sheet exploded from $900 billion to over $4 trillion as they bought massive amounts of bonds. The European Central Bank and Bank of Japan did similar programs, but QE has side effects. All that new money has to go somewhere, and much of it ended up inflating asset prices. Stocks, bonds, and real estate all rose dramatically. This helped people who owned assets, but did little for those who didn't. Critics argue that QE increases inequality. Rich people own most financial assets, so they benefit most from rising prices. Meanwhile, savers get hurt by low interest rates, and young people find it harder to afford homes as real estate prices soar. Capital markets. Capital markets are where long-term money changes hands. Think of them as giant matchmaking services connecting people who have money with people who need money for longer than a year. The stock market is the most famous capital market. Companies sell shares to raise money for expansion, research, or paying off debt. Investors buy these shares, hoping the company will grow and the stock price will rise. It's a win-win when it works. Bond markets are even bigger than stock markets, but get less attention. When governments or companies need to borrow money, they issue bonds. A bond is basically an IOU. that pays interest over time. Investors buy bonds for steady income and relative safety compared to stocks. Capital markets can be volatile and unpredictable. Prices swing wildly based on news, emotions, and speculation. The 1929 stock market crash helped trigger the Great Depression. The 2008 financial crisis started in mortgage markets. Central banks. Central banks are the most powerful institutions you've probably never thought about. They control the money supply, set interest rates, and can literally create or destroy trillions of dollars with a few keystrokes. The Federal Reserve is America's central bank. The European Central Bank serves Europe. The Bank of Japan serves Japan. Every major economy has one. Their job is to manage monetary policy and maintain financial stability. Central banks have several tools at their disposal. They can raise or lower interest rates, making borrowing more expensive or cheaper. They can buy or sell government bonds, injecting or removing money from the economy. They can change reserve requirements for commercial banks. Central banks also act as lenders of last resort. During financial panics, they can provide emergency loans to banks that are facing runs. The Federal Reserve was created in 1913 after a series of banking panics convinced policymakers that America needed a central bank. Before that, financial crises were more frequent and severe because there was no institution capable of stabilizing the system. Consumer confidence. Consumer confidence is economics meets psychology. It measures how optimistic people feel about the economy and their personal financial situation. And, surprisingly, these feelings have real economic consequences. When confidence falls, people tighten their belts. They postpone big purchases, build up savings, and prepare for tough times. This reduced spending can actually cause the economic problems people are worried about, creating a self-fulfilling prophecy. Consumer confidence is measured through surveys. Pollsters ask questions like, do you think business conditions will be better or worse 6 months from now? Are jobs plentiful or hard to get? Do you plan any major purchases in the next 6 months? Consumer confidence can be fickle and irrational. It's influenced by news headlines, stock market movements, political events, and even weather. Good economic news boosts confidence, leading to more spending, which creates more good economic news. Bad news has the opposite effect. Bull versus bear markets. Wall Street loves animal metaphors, and none are more famous than bulls and bears. These aren't just cute nicknames. They represent fundamentally different market environments that affect everyone's financial life. A bull market is when stock prices are rising consistently over time. Bulls attack by thrusting upward with their horns, so rising markets are bullish. During bull markets, investors are optimistic, confident, and eager to buy. Bear markets are the opposite. Prices are falling consistently, usually defined as a 20% decline from recent highs. Bears attack by swiping downward with their claws. Hence, falling markets are bearish. Fear dominates. Investors sell and portfolios shrink. Bull markets can last for years, or even decades. The longest bull market in US history ran from 2009 to 2020, over 11 years of almost continuous gains. During this period, the S&P 500 rose over 400%, creating enormous wealth for investors. Bear markets are typically shorter, but more intense. The average bear market lasts about 14 months and sees prices fall 35% on average. But some are much worse. During the 2008 financial crisis, stocks fell over 50%. What causes these market cycles? Bull markets are driven by economic growth, rising corporate profits, low interest rates, and investor optimism. Bear markets result from economic problems, falling profits, rising interest rates, or external shocks. The key insight is that both bull and bear markets are temporary. What goes up eventually comes down, and what goes down eventually goes back up. The stock market has experienced dozens of bull and bear cycles, but the long-term trend has been upward for over a century. Stagflation. Stagflation is economics' worst nightmare. It's when you get high inflation and high unemployment at the same time. According to traditional economic theory, this shouldn't happen. But the 1970s proved that theory wrong in the most painful way possible. The 1970s stagflation was triggered by oil price shocks. OPEC quadrupled oil prices in 1973, then doubled them again in 1979. Since oil is used in almost everything, this drove up costs throughout the economy. But instead of boosting growth, it caused recession. President Carter appointed Paul Volcker as Federal Reserve Chairman with a mandate to break inflation at any cost. Volcker raised interest rates to unprecedented levels, over 20% at one point. This caused the worst recession since the Great Depression, with unemployment reaching 10.8%. But it worked. Inflation fell from over 14% to under 4%. Modern central banks learned from this experience. They focus heavily on managing inflation expectations through clear communication and credible policies. They also respond more aggressively to supply shocks to prevent them from becoming embedded in the economy. Globalization. Globalization is the process of the world becoming more connected economically, culturally, and politically. It's why you can buy a smartphone designed in California, manufactured in China, using materials from dozens of countries, all for less than what a basic phone cost 30 years ago. Trade is the foundation of globalization. Countries specialize in what they do best and trade with others for everything else. But globalization goes beyond trade. It includes the movement of capital, technology, and people across borders. Multinational corporations operate in dozens of countries. Investors can buy stocks in Tokyo from their bedroom in New York. Engineers in India write software for companies in Silicon Valley. The benefits of globalization are enormous. It has lifted hundreds of millions of people out of poverty, especially in Asia. Consumers enjoy lower prices and more choices. Companies can access global markets and talent pools. Innovation spreads faster as ideas cross borders freely. Recent years have seen a backlash against globalization. Brexit, trade wars, and rising nationalism reflect growing skepticism about international integration. The COVID-19 pandemic exposed the risks of global supply chains when borders closed and production stopped. The economy isn't just numbers on a screen or abstract theories in textbooks. It's the system that determines whether you can afford rent, find a job, or retire comfortably. These concepts affect your daily life in ways you might not even realize. The economy is complex, but it's not mysterious. It's driven by human behavior, constrained by scarcity, and shaped by the institutions we create. By understanding these basic concepts, you're better equipped to navigate the financial world and build the future you want. If you like this breakdown, make sure you hit like and subscribe so you don't miss the next one. And if you have a topic you want me to explain next, drop it in the comments. I read every single one. See you in the next video.